talking point, of course, also has been the L&T results. The stock was down sharply yesterday, and the disappointment largely is on the margin bit. Otherwise, I mean, it's been a pretty healthy set of numbers which we've seen across the board from the infra major. The company's guided for a 10% growth in order inflow in FY25 on what was already a very elevated base. Mr. R. Shankar Raman is President, Whole-Time Director and CFO at Larsen and Toubro. Mr. Raman, thank you very much for your time. Great to have you with us here. Thank you for joining us. Prashant, this side. You know, margins is what I guess everyone is very focused on, and we'll come to that. But I just want to start by talking about the pipeline, right? Essentially, my question is to you about what we are hearing from Saudi Arabia in terms of, their spends on infrastructure being lowered, be it Aramco, be it that new city which was to come up. And these are sort of public statements we've heard. You've, sir, in commentary, essentially said that your pipeline is very, very strong for orders. FY25 pipeline is about $146 billion. That's up 24% year on year. In 24, this number was 14% higher. Have you factored in any sort of disturbance which comes from Saudi, or is it inclusive of this? Can this number reduce pretty dramatically as we go through the rest of the year? What are you seeing?
Good morning, Prashant. Good morning, viewers. Thank you for having me on the show. I think the way we look at pipeline is looking at all the prospects that the clients are working on. The time factor that it takes for some of these to actually convert into specific programs, thereafter to RFPs and thereafter to awards, is a pretty long one in particularly project business. So the first sign that we look at is how consistent and strong is the pipeline. And when we look at it from that perspective, 12 lakh crore or close to $150 billion worth of opportunities are looking available for investments to be made both in India and Middle East. Stepping back a bit on this pipeline, I think since we have 60% of our business coming in from India and 40%, we have to constantly keep looking at both the opportunities because the sizes of these opportunities are different and the resources that needs to be engaged in these opportunities are also vastly different. So considering that, we need to balance between our resources as well as our plans and growth aspirations. We constantly look at both and try to see where we can scale up. The advantage with Middle East so far has been that they've been investing in oil and gas, the geopolitical tensions, the frozen wars in Europe, etc., has led to a situation where pumping out more oil and gas energy continues to be profitable for the Middle Eastern companies. Oil at around $80 and thereabouts seems to be a fairly sweet spot for them to be able to cater to the global demand as well as generate resources for them to build their economies in a more broad-based fashion. There is a very stark realization over the last 5-7 years in these markets about the need to develop their business from a one-pony trick to a much larger economic engagement. The people are getting educated. People in Middle East needs to find profitable vocation. And consequently, the development of Middle East started towards, instead of a one-city region of Dubai hogging all the limelight, we are now having alternate cities coming up. One is existing infrastructure getting strengthened. Middle East always was known for excellent roadways, but they did not really spend much time and energy or money in developing rail network. The cities were far-flung, so possibly they didn't have the compulsion. Now, as you can see, if you travel there, Dubai and Abu Dhabi is almost connected by various development along the way. So it looks like one continuous stretch now as compared to what it was a few years ago. Now, given this development and the migration of people wanting to live there, because the social conditions in those regions are also improving. So if you look at Middle East from a holistic point of view, oil and gas will continue to be the fund provider for many of their efforts. The transition that they have done for solar is remarkable. We ourselves as a company are working on 18 gigawatts of solar power, and we're the single largest contractor out of India working in Middle East on this area. uh, given that trust that they have, because they have enough and more land, they have enough and more sun.
Yeah.
So it's
Yeah.
actually a no-brainer that solar
Mr.
capacity
Shankar,
will come there thick and
yeah,
fast.
Mr. Shankar, since we, I don't know, fantastic points and a really sort of comprehensive explanation about what's happening there, and that trend will continue. But could you tell us what is your exposure from the Middle East? What's the exposure in terms of order booking from Saudi? If you can give us those two numbers, and as of now, you're not hearing anything, not just for you but for others in the market, because you'd hear what's happening. No cancellations, no ram downs, nothing.
Yeah, we have totally the order book is about 4,75,000 crores, and we have almost 1,80,000 crores in the international markets. 80% of this order book is from Middle East, and within that 80%, almost 70%, 72% is Saudi. So Saudi dominates the order book. We have close to 1 lakh crore out of just that market in Saudi, and over Middle East it'll be maybe 1,25,000 crores. So that's the size of the pie that we have. These are orders that we have got in the bag, and this excludes the bids that we are evaluating for submission going forward. There would be a pause in terms of reallocation, because I think the sectors to which they want to reallocate capital, we've seen announcements, particularly from Saudi Aramco. But on a $60 billion per annum base of investments that they're talking about, a 10 billion shift is what they're talking about, 40 billion in 4 years. A 10 billion shift, according to me, is not going to upset our plans for Middle East, given our size and scope of engagement.
All right. Hi, good morning, Mr. Shankar Raman. Good to see you in. This is Nigel on this side. What about the core margins? The street seemed a little bit disappointed with the guidance you've given out there. Do you think that you're being a little bit conservative on the guidance you have given? And is there an upside risk? And tell us why you're being so conservative.
We need to understand this margin business a bit. I know the street is not very happy by seeing a number at 8.2% that we have reported for the core. The portfolio as a whole has reported 10.6%, but you leave aside the services business and you just talk about projects and manufacturing business, we have printed 8.2%. And this was 8.6% last year. Last year, when we printed 8.6%, we were committing our resources towards earning this margin, almost 18-19% of our revenues. The 8.2% that we have reported for FY24 has 12% of revenue committed as resources. Now, in terms of this value creation, margin is one piece. The other lever is capital employed. How much capital do you employ to earn the money is a most important aspect in this. And what the street possibly has missed out is that the capital efficiency that we have packed in rather very well in FY24, we seem to have sort of lost sight of it. Secondly, the changing mix definitely has a role in all of this. Earlier, we used to be 20%, 22% of our order book used to be international. Today, it's 40%. What this means is the size of the projects goes up, so scale is high. Secondly, the absolute margin in Middle Eastern contracts are lower than Indian contracts, but the cash terms that are available, the payment terms, the milestone payments, the front-ending of cash flows are much stronger in Middle East. Now, given that the changing mix of international domestic order, it is to be expected that the 9%, 9.5% we used to print as margins when we are only focusing on India, essentially, will change. The point that is to be appreciated is that changing without any change in capital employed, or is it changing in tandem with capital employed? If I context it that way and look at the performance of the company, I think the value we have generated is reflected by 200 basis points improvement in ROCE and almost 270 basis points improvement in ROE. Now, we do believe we have created value for shareholders through the FY24 performance, and we'll continue to do that going forward. The margin and the capital employed are two levers which are dynamic, which will keep moving depending on the type of contract, the geography, etc. So my advice would be not to unduly lose sleep over the margin, but look at the overall value creation efficiency that we are demonstrating. But having said that, the company is committed and will do everything possible within our means to make sure that the margin improves to better levels, even during FY25. But given the fact we are almost looking at a 7-month or an 8-month year ahead, we thought that it may not be prudent for us to upscale this now, and maybe we'll reserve some good news for FY25, 26.
Okay, no, but take your point. So it's a balance, as you put it. So just focusing on that one number may perhaps not be the right way to do it, and perhaps the market will take note of that as well. Because of the elections this time around, briefly, Mr. Shankar, I had a few more questions. Is there any impact you're already starting to see, or not really?
In terms of the bids that we have submitted, the opening has got delayed. Obviously, I think once a code of conduct is announced, there is an inevitable slowdown, and that was actually anticipated, and this is the reason why we almost did 75% or 80% of what we need to do for the year by December. And we could then enter the last quarter with not so much of stress of having to meet the target. We well exceeded the target. During the months that we are seeing now, and maybe right up to the election results, I don't expect these bids to be opened. So it's going to be more of focusing on executing. And as elections are happening, I think all our contract workforce are also getting scattered because they are all going back to their villages to cast their vote and whatever. So to that extent, there's going to be a bit of a reassembling of workforce. So from July or June end, our execution will start gathering pace to come to normal. In terms of fresh orders, I think the first phase would be to open up the bids that have been submitted. If there is continuity in the government and its policies, these bids will be opened and then awarded. If there's going to be a discontinuity, which I don't know how things will pan out, then there's going to be a question of what happens to these bids. Are they going to be cancelled, resubmitted, etc.? So there is an inevitable interruption that this event of national importance will throw up. And hence, we are thinking that for fresh orders to come in, it could be more from August, September. So it looks like a second half heavy year going forward, and which is largely the reason why we also scaled down the growth to about 10%. Not to say prospects are dimmer, it's just that ability, the time that is taking to convert all of this into specific orders could take all the time up to March 25.
Okay, maybe I can got that, sir. So it's like an H2 heavy kind of year. Two more questions. How are ridership trends in the Hyderabad Metro? Is it on track for divestment? There is one. And can we expect a buyback next year given the strong cash generation overall from the company?
As far as Hyderabad Metro is concerned, I think FY23 we closed there with average ridership of about 3.2 lakh per month, per day. And the ridership has improved to 4.6 lakh per day as we closed FY24. In the month of April, we have seen about 4.7, 4.75 lakh per day ridership. I think it is very important that in the space of public-private partnership, the public policies have to actually take into account the private capital commitments. We had a new government in the state of Telangana, and one of the poll promises, which seems to have been implemented right away, was free bus passes to women of all age. Now, that shifted close to 40,000 people who were traveling in metro into the buses, because I think a free bus ride, free lunch, everybody prefers. But what it is also doing is pushing some of the men folk who are finding the buses very crowded back to metro. So we think that there'll be a shift, and some amount of gender diversity will not happen in the ridership. It will be a little more male oriented. So we guess we'll get this traffic with some lead lag. We should be able to get this 5 lakh people back on the metro. Secondly, I think Hyderabad does have a lot of IT professionals working and using the metro. The return to work is still not complete. People are still working from their homes, etc. To that extent, the ridership is punching below its potential. It has potential to have another 50,000, 70,000 people traveling if the IT crowd really comes back to office. And the third part of it is we have about 18.5 million square feet of real estate attached to the metro. We've got approval for monetizing a few bits of that, which we did in FY24. Approval is pending for a few more bits in FY25. And the state also has granted a soft loan, long-term interest-free soft loan of 3,000 crores, of which we have drawn 900 crores. We need to draw the balance 2,100 crore. So a bit of improved ridership, bit of monetization, and a bit of time crunching
Got it.
in terms of getting the soft loan will help us repay the debt. And the minute the debt equity improves for the project, even at about 5 lakh riders, then the asset becomes a little interesting to evaluate from an investor point of view. It is an asset we will monetize, but we'll have to make sure that we don't monetize at some discount and that it is monetized to its potential. Very few concessions are for 65 years in the country, and this is one such. So there's lots of cash to be had for investors at the back end, but we are going through the formative phase, which is the harder grind that we are passing through now. As far as buyback, etc., I think our idea was to make sure we create value for shareholders. Dividend and buyback are part of the entire shareholders return program. As and when, and we have made a start because first time ever the company did a buyback last year and it's been well received. So we've sort of tasted that's a workable option. We'll continue to evaluate that, and we are very clear that we are handling shareholders' money as its custodian. If we can't put that to best use, it is best to give back the shareholders their money, and they can choose what they want to do, including investing in our stocks.
Okay, all right. Well put, Mr. Shankar. Great clarity there. Thank you very much for your time. It's a pleasure having you with us here on CNBC TV18. Good luck, sir, as you sort of conduct your business through F525. We'll speak with you again. The stock's absolutely flat, down about 1/3% after yesterday's 6% sell-off. The Nifty